Welcome to the Lockshield Partners Podcast. We believe in financial literacy and love to provide quality information when it comes to areas around financial planning and how it impacts your life. To learn more about what we do and how we serve our clients, visit us at lockshieldpartners.com.
Dan, welcome back. We've got another edition of our Lockshield Partners podcast today. And today we're going to dive into beneficiary IRAs.
Beneficiary IRAs, that's exactly right.
Yeah. So let's start off maybe very simple. Dan, put one on the tee here for you. What's a beneficiary?
Sure. So a beneficiary is simply who gets your stuff. So a primary beneficiary is this is the first person. You can have multiple beneficiaries. A contingent or secondary beneficiary would be in the event my primary beneficiary, like my spouse, predeceases me, dies before me. This is who I want to get it. And there's different, not to get too deep in the weeds right off the bat, but there's different, you can name them per stirpes or pro rata. You want to hit that one?
Sure. Yeah. High level. If you've got two beneficiaries, let's say pro rata would be when you pass away, they split your stuff evenly. Pretty straightforward. If depending on how you have it set up. Per stirpes would be if one of those beneficiaries passed away before you, then their share would go down the line of descendancy as opposed to the other primary beneficiary that was named.
In the event one of the beneficiary predeceases. Right.
That's
so
exactly right.
pro rata just means whoever's still living, it's split among them.
Correct.
Yeah, that's exactly right.
Yeah. Fun fact, Dan, about beneficiaries. So anytime that someone has a named beneficiary on a retirement account, on a life insurance policy, on a bank account, whatever the case may be, it does not matter what your will says.
That's right.
Whoever the named beneficiary is on that account, that's who's getting those funds.
That's exactly right.
So one thing that we like to recommend to our clients, check them every year.
Yep. Easy to do.
Most people don't.
Yep. The will is
Easy to
just to
forget.
catch whatever assets aren't already told where to go.
Right. Right. So let's dive into this,
Yep,
Dan. So
let's do it.
somebody passes away and they have retirement assets.
Right.
If the spouse is still alive and the spouse is the beneficiary, what happens?
Special rules for a spouse. The IRS looks kindly on a spouse. The spouse can just take it as their own IRA. That's what a lot of spouses do, especially if they're over 59 and a half. However, if they're younger, if they're under 59 and a half, they have a couple options. You want to take those?
You keep running.
Sure. So under 59 and a half, you can take it as your own, but then you have to play by the rules if it's your own IRA. Primarily speaking to distributions.
Wait till 59 and a half to take distributions.
Correct. But a spouse could leave it in their spouse's name as a beneficiary IRA, which would remove the 10% penalty for under 59 and a half. And then when they reach 59 and a half or later, they could then move it into their own IRA.
Yeah. Gives them a lot more flexibility that way.
Yes, indeed.
So here's where it gets a little bit messier. Let's say that the second spouse passes away with retirement assets. And so now the kids or the grandkids or whomever, a non-spouse is inheriting those assets.
Right.
So there's a couple different rules here. I'll take the first, you take the second.
Okay.
So for folks that passed away prior to 2020, so a 2019 decedent or prior, those beneficiaries kind of fall in a sweet spot.
Yeah.
Those beneficiaries get to take advantage of what some people refer to as the stretch IRA, meaning that, yes, they are required to take an annual distribution. We've referenced RMDs before, so make sure to check out that podcast. They are required to take out a distribution annually, but typically speaking, it's a fairly small percentage of the overall account balance.
Right.
And they can stretch that over the course of their lifetime.
That's why it's called stretch, because they can stretch it out.
Right.
If they need to or want to take more, they can, but the required minimum distribution is much less.
The other nice thing, Dan, it's not like they're locked in to only that required distribution.
Sure.
So if they wanted to take out more
in any given year,
they can.
Right.
There's no requirement on what they spend it on, or
Right.
what they use it for. There's no penalty.
It's just
regardless
taxable.
of age. It's just taxable.
Right. And the IRS saw that and thought, that's a really good deal. So
we better change that rule.
You better change that rule. So beginning in 2020, they changed that rule. You can no longer have a stretch IRA if you are a non-spousal beneficiary. They simplified it, which is not necessarily in the benefit of the beneficiary. Now it's 10 years. And in only the way the IRS can, originally they did not give us a lot of direction on that, which they have clarified that. So for most people, and practically what this means is, hey, every year you've got to take out a chunk of money. And what we tell clients is in year 10, it's 1/10. In year 2, it's 1/9, 1/8, 1/7,
so on and so forth.
so on and so forth. If you want to take it all out the first year, you can, but the IRS says, hey, we'd like to get paid on that money.
Yeah.
So go ahead and start taking it out.
Yeah, it really changed the planning discussion around it a lot.
Definitely.
And that 10-year rule really, really hampers your flexibility. And let's dive into that some. As you mentioned, at first there wasn't a lot of guidance. Now you do have to take an annual amount. We're still awaiting some guidance on what that looks like for
Right.
2025. What you mentioned is a good rule of thumb to go about it, though. So from a planning standpoint, if we assume that, especially at this point, most people are going to fall into the second bucket, unless you already have a beneficiary IRA from years ago. What should people do
Sure.
to help use these resources efficiently? Because it's still something that can be beneficial in our long-term
Sure.
context.
So from a financial planning point of view, well, before we get into that, from a personal point of view, you know what? Money is a resource. It's not always meant to be saved. So maybe there's some portion of that money that somebody wants to use to honor the decedent.
Very common.
Very common. Nothing wrong with that. But from a financial planning point of view, let's get into efficiency. So one thing to do, because if this is a traditional IRA, the money's taxable to you. Well, a simple way to offset that is just to increase your 401k contributions.
Great. So I have a $2,500 distribution from my beneficiary IRA. I turn around, I increase my 401k contribution by $2,500.
It's a wash. It's a tax wash.
Nice.
Yep. You take $2,500 out of the IRA.
Essentially, we're saving that money,
That's exactly right.
keeping that money, however you want to
Yep.
put it.
Yep.
I think it's also wise, you would agree with this, if you have high interest rate consumer debt floating out there, you can back into the math to see, okay, what's my tax liability, what's my interest savings, so on and so forth. That could be
just strengthening the balance sheet, freeing up cash flow.
Right.
And one thing to keep in mind is if it's going to cost you, let's say 12% or 20% in taxes once versus I'm paying an 8% car loan every year
Annually.
or a 20% credit card rate.
Right.
A 3% mortgage, that's probably a discussion to have.
Right.
But it sometimes makes sense to pay off some debt.
No doubt. No doubt. So a couple things as we wrap up here, Dan, important things to remember. If it is from a traditional IRA, the distributions are taxable.
Correct.
They're not penalized.
Yeah, that's a big one, regardless of your age.
Right.
If you're
Regardless of
20
your age.
or 40,
Yeah.
it doesn't matter. The 59.5 does not apply.
Doesn't apply. One thing I do think that's important to keep in mind is if a large distribution is taken in a given year, that can definitely alter the marginal tax bracket, that could have a waterfall effect.
That's right. It could affect a
sometimes.
lot of different things.
So that's just something to be aware. Not that that's a bad thing to do. Maybe it does
Correct.
make financial sense. Just have those conversations with your accountant prior to.
Right. And then of course we love Roth assets. And here's another reason why we love Roth assets. They're tax-free. Now, a beneficiary of a Roth IRA still has to take distributions.
Right.
But from a tax point of view, it doesn't matter. It's not
Still doesn't
taxable.
impact them.
Yeah, I mean that's
They're keeping 100% of that money.
100% of it. Another
So-
reason why we love Roth money.
Absolutely. If you have any more questions about beneficiary IRAs, make sure to check us out at lockshieldpartners.com.